Hey everybody, Matt from 90th percentile.ca here. For access to more study notes, practice questions, mock exams, and end of chapter question videos, visit 90th percentile.ca and sign up for your free trial today. Link below in the description. All right, income taxes, fun stuff. This module sucks, let's be honest. No one likes taxes. Tax is a really tricky topic. Like even people who've been working in the tax department of like a big four accounting firm, they always have to learn new stuff every year. The laws change all the time. There's always new stuff going on. But I think the curriculum does a pretty good job here of, kind of narrowing our focus. Um, Once again, I think the explanations in the book are a little overcomplicated, but nonetheless, really the key point of the income taxes module is to be able to recognize deferred tax assets and deferred tax liabilities. So we have to understand what these are. These are balance sheet accounts, right? You have to understand what they are, what causes them. So the quick summary is, they're caused by differences in accounting profit and taxable profit because they're two different things. Um, and we're also going to be given some financial information. And we have to recognize whether a deferred tax asset or liability is created when we have differences in accounting expenses and taxable expenses and accountable or accounting balance sheet items and taxable balance sheet items, so like assets and liabilities. And then we'll also talk about how some of these items, depending on what you're accounting for, can cause either temporary differences, which will resolve themselves over time, or permanent differences, which will never resolve themselves, and give rise to some other tax complications. But with that, let's just jump right in and get this one over with. All right, before we jump into this one, just really quickly want to give a overview on deferred tax liabilities and deferred tax assets. The book kind of complicates it too much in my opinion, but put very simply, if we come down here, I like to use deferred tax assets to explain it first. Basically, for any company, there are two sets of financial statements. There are the financial statements that me and you see, like their annual reports and all of that that's public. And there's also a set of tax statements, which the public never sees. They're just between the company and the government. Like it's quite frankly, none of our business to see them. And there's slightly different accounting policies that companies can take for their financial reporting that we see and um, the tax reporting. So like a good example of that is accounting accounting standards using different depreciation methods versus the depreciation methods used for tax accounting, etc. But once again, put really simply, if you come down here to a DTA or deferred tax asset, this occurs when your taxes payable, so what you actually pay to the government, is greater than your accounting tax expense on your income statement. So this creates an asset because it's like a prepaid asset, right? So we paid more than what's on our books. So due to that, we're gonna have to create a deferred tax asset account because it's like we're prepaying essentially the tax from an accounting perspective, right? So we would decrease cash and increase our deferred tax asset to make these two equal. So then on the flip side of that, we have the case where our taxes payable, so what we actually pay to the government, is less than our accounting tax expense. And in this case, we would create a liability, a deferred tax liability, because we're going to have to pay more to the government at some point in the future, right? Because what we actually paid was less than from accounting purposes. So the way I like to think of it is this deferred tax liability and deferred tax asset is from the, you know, financial statement perspective, not the tax perspective, because these two accounts are used to make our actual taxes payable and our accounting taxes payable equal through the financial statements. So with that, we can come to this question, which is saying using the straight line method of depreciation for reporting purposes and accelerated depreciation for tax would most likely result in a valuation allowance, a deferred tax asset, or a temporary difference. Um, so a valuation allowance is actually a reversal against a deferred tax asset, so that has nothing to do with this. Um, that's mainly like valuation allowance. You usually reverse deferred tax assets um, when it's determined that a temporary difference. So like in this example, you have a straight line depreciation method and a accelerated depreciation method, which will cause a temporary difference in the first couple years, but eventually over time, when this asset is, you know, reduced to its residual value, the difference will resolve, right? So this valuation allowance is used in different cases when it's determined that the temporary difference will not reverse in the future. And for B, is it a deferred tax asset? Well, let's use like a really simple example. Let's say I'm using straight line depreciation here and accelerated here. And we're just going to draw a really simple income statement. Let's say we both have 10 mil in revenue, and then our only expense is depreciation. So using straight line, let's just say it's 2. So we're subtracting 2. So we have an 8 million taxable income. And then accelerated, of course, going to have more depreciation. So let's just say it's like 5. So we're going to have 5 million in taxable income. And the accelerated was for tax purposes. Straight line was for financial. So in this case, for tax purposes, the taxes that we're actually going to have to pay, let's just say our tax rate is like 25%. So for tax purposes, we have a 5 million taxable income times 25%. We're going to have to pay 1.25 million in tax according to the government. Whereas here, same tax rate, 25%, we're going to have to pay 2 million in tax um, on the financial statements, right? So coming back to here, we have taxes payable according to taxes being less than our accounting tax. And this is going to cause a deferred tax liability, not a deferred tax asset. And our answer is C, temporary difference. You know, I've kind of touched on it a couple times now, but at the end of this asset's useful life, when it's reduced to 0 or its residual value or whatever, this temporary difference is gonna resolve itself over time. Because as we know, like using accelerated depreciation in the later years, this 5 million will become much lower than the 2 million, and the 2 million will stay the same. So over time, it will resolve itself. Next, income tax expense reported on a company's income statement equals taxes payable plus the net increase in deferred tax assets, deferred tax liabilities, give some combinations of these. So the formula for income tax expense, this kind of goes back to what I was saying earlier about how these deferred tax assets and liabilities are used to equate um, taxes payable to our income tax expense, which is accounting. So this is up here is what I said earlier, right? So deferred tax liabilities occur when the taxes payable is less than the income tax expense. So if we just forget about this for now, and we have taxes payable, let's say it's 100, and income tax expense is 150, then we would have to add the change in our deferred tax liability, right, which would be 50 to make these equal. So you can kind of see how this formula here relates to this formula here. On the flip side, for deferred tax assets, if taxes payable were greater than income tax expense, we could have like 150 here and 100 here. And we have to subtract the 50 deferred tax assets to make them equal. But you know, kind of two different ways to look at it. I personally like to use this formula, and then from there I can um, you know, kind of back calculate this and understand when a deferred tax liability and asset is created. Um, but regardless, you know, to summarize, the income tax expense on the accounting statements is equal to your taxes payable, so this is actual tax, plus the change in your deferred tax liability. So this is like, you know, the change over like the period that you're reporting, so it might be like quarterly or yearly change, and then you subtract the change in your deferred tax asset. So it's a pretty easy question if we know the formula here, and the answer is taxes payable plus the change in deferred tax liabilities less the increase in deferred tax assets right here. company incurs a capital expenditure that may be amortized over 5 years for accounting purposes, but over 4 years for tax purposes. So what's the company going to record? A deferred tax asset, deferred tax liability, or no deferred tax asset or liability? Well, we can cross this one off. We know that there's going to be a difference because we're doing 4-year depreciation for tax and 5-year depreciation for accounting. So I did I find these tax ones are a lot easier to understand with examples. So I took CapEx. I just assumed it to be 1,000 for accounting. We're depreciating it over 5 years, so 1,000 over 5 is 200 depreciation, and we're left with an end of period value of 800 at the end of the year. Well, for tax, it's the same thing, 1,000, but depreciating it over 4 years, so 250 depreciation and then 750 um, end of period balance. So also note that this is CapEx, so it's an asset. Um, I took this table down here, which summarizes when you're dealing with assets and liabilities, whether it's carrying value, so the carrying value would be for accounting purposes, or it's tax base is like the carrying value for tax purposes. When there's a difference between these two, depending on if you're dealing with an asset or liability, if this is greater than this or, less or whatever, then it's going to result in a deferred tax liability or asset in these cases. So for an asset, if the carrying amount, which we have here is 800, is greater than the tax base, which is exactly our case, then you get a deferred tax liability. And then the opposite would be true if, this was like 650, this was still 750, then it would be deferred tax asset. And then on the liability side, it's just completely flipped. But like there's, I guess, 3 different ways to remember this tax stuff. For me, it's usually a bit confusing. But one was what I went over in the first question, where we have deferred tax liabilities and deferred tax assets are created depending on taxes payable, and income tax expense on the accounting statements. So this is one way to kind of remember it. The second way, which is my preferred way, would be to do something like this where I draw it out. And then I know this isn't really like an income statement, but the way I look at it is we can take this CapEx, and even though this is technically an end of period balance, you can just assume what I did earlier, where this is like a company's revenue and this is their depreciation, and those are the only expenses that they have. So under accounting purposes, I'll be taxed on $800, whereas for tax purposes, I'll be taxed on $750. So I'm going to pay more tax here and less tax here, right? So in this case, once again, we would have taxes payable, or we're actually paying being less than our accounting tax, which would cause a deferred tax liability. So that's usually the way I think about it. It might be a couple extra steps, but it just kind of makes sense to me. So pick whichever way you feel comfortable with. So like I said, one was just remembering the relationship between taxes payable and income tax expense. Two is kind of drawing it out in a P&L, and then three is this table here. So pick one of them, remember it, understand it, because it's easy to kind of trick you up here. So just to be sure we're getting these right on exam day, because they're going to be asked for sure. Just pick one and stick to it, and really memorize it or understand it or whatever. When accounting standards require recognition of an expense that is not permitted under tax laws, the result is A, deferred tax liability, temporary difference, or permanent difference. Well, if we're expensing something on our accounting statements and we're not allowed to expense it on tax, so you got to say, like the easiest example I can think of for this is, and some of you might be familiar with it or not, but typically I think in the US, but for sure in Canada, when you have like client entertainment or meals expenses, only 50% of it is deductible for tax purposes. So like let's say I spent 1,000 on a meal for me and my clients. On my accounting statements, I can, expense the $1,000. But for tax purposes, only 50% of this, so 500, is deductible for tax purposes. So this is never gonna resolve itself. Like we're not gonna undo this at some point. Um, versus, the examples that we went over with accelerated versus straight line depreciation, those will cancel each other out or reverse at at the end of the asset's useful life. But this is just 500 bucks that's just in limbo. So it's never going to resolve itself. This is the example I like to think of for a permanent difference. We have a company who prepares the statements under GAAP in year three. Year three, what do we have? A valuation allowance of 1101 against deferred tax assets and DTA of 19,201. And then in year two, okay, see, they're messing around the ordering of this. So like year three is up here in the year two. Just trying to trick you. So be careful of that. So year two, valuation allowance of 1325 and DTA of 17,325. So what are we asking? The change in valuation allowance most likely indicates that Zimit's deferred tax liabilities were reduced in year three. No, it has nothing to do with deferred tax liabilities. Um, expectations of future earning power increased or decreased. Okay, so a valuation allowance, I kind of touched on it a bit earlier, but it is recognized when, and the accounting terminology is, it's more likely than not. So, we can kind of assume it's like 50% or greater than 50%. But this is like the official accounting terminology, of course. Just gonna make it more complicated. It's more likely than not that they'll fail to earn sufficient income to offset the deferred tax asset. So the actual, like how this actual, 1325 and 1101 is calculated it's outside of the scope of the CFA curriculum. And it's like, you know, people are in tax, they work tax jobs for their whole life and tax laws are always changing. So like we don't need to know how this number is calculated. All we need to know is and recognize is when these exist, what do they mean? And when there's a change in them year over year, what does that indicate about company's expectations? So in this case, we have year two at the bottom, and then year three, it's decreasing by like 200, right? So if the deferred tax allowance is decreasing, that means that their expectations of future earning power have increased. Because if, like we said, they're taken when it's more likely than not that they won't have enough income to offset this deferred tax asset in the future. So if this amount is decreasing, then expectations about the future are looking better.